Most high earning professionals want to understand disability insurance, but the process often feels outdated, confusing, and overly complex. At the same time, advisors are under pressure to explain income protection clearly while the products themselves become more technical. That gap between what clients need to understand and what advisors have the tools to explain is where today's guest has built his career. Michael Sir is the president and co-founder of One Protection, a platform designed to modernize how advisors present disability insurance. Before launching the company, he spent more than 20 years as a disability income regional vice president with Principal Financial Group, helping advisors across the Midwest navigate disability planning for business owners and key employees. His perspective combines deep product expertise with a frontline understanding of what clients still struggle to grasp. He's here to talk about how technology is changing the way income protection is taught and delivered. He joins us now. Welcome, Michael.
Thank you, Jamie. Thank you for having me.
Thanks for being here. I'm really excited to have you here on the show today because, number one, you have such a passion for income protection that I think really permeates through the screen. And I'm really excited to just hear your voice and hear your experience. You have a wealth of knowledge. And the other reason I really wanted to bring you on is because there's finally a tool that will help people visually see why income protection is so important. Because a lot of times we're just talking about these things and they're sort of in these vague, ambiguous terms. So I think, when we get into that part where you're showing people the screen and what the numbers really look like, it can really be a game changer. So the first thing I wanted to ask you is, a lot of people have heard about disability insurance and income protection, but they're not even sure what it is. What is the most simple way to explain income protection?
Yeah, what a great question. It starts there and I like how you say income protection versus disability insurance. And the problem with the word disability is it conjures up things like Stephen Hawking's or Christopher Reeves and something really, really, really dramatic when in fact, in the real world, disabilities come in a lot of shapes and forms. And by talking about income protection, we understand that we're talking about the most valuable asset that all working Americans have, which is the ability to get up in the morning and go to work and make money and so on. What income protection and the insurance part of it is to make sure that income is properly protected against sicknesses or injuries that keeps them out for an extended period of time. We know that the number one reason for bankruptcies and home foreclosures are health events. Mm-hmm. That's what destroys financial plans is when you don't have the income, the fuel to everybody's financial strategy properly protected, then there's not enough money coming in and it starts to cascade in a bad way from that point forward. So that's what income protection is. It's an insurance to make sure that no matter what happens, if you're not able to work due to an injury or an illness, that you still have money coming in to keep your lifestyle protected.
Yeah, so you worked a lot in the field and in discussing it. And how did you decide to go from, working in a home office into creating your company? What was sort of the thought process behind it? And then we'll go from there. And then how did you create it? And what did you want to really convey?
Sure. Well, having done this, I'm in my 40th year of being in this business. So I've been doing this for a while. And my business partner was a financial advisor. His name's Jim Leary. And Jim was a financial advisor, and he kept coming to me saying, "Hey, man, you got any better tools?" Because he's meeting with clients and having a hard time getting this point across and really having this conversation. So we set out to come up with a different mousetrap, something that is much more visual. And to be quite honest, I got really sick and tired of watching advisors struggle in this area of planning. It's so critical, but yet we just didn't have the tool or the tools to get this point across. And so that's what One Protection, name of our company is One Protection. Our tagline is protecting the one asset our clients can least afford to lose, which is income. And so if we can't adequately demonstrate the problem and help the client understand what their situation is, it goes unnoticed, and it just gets glossed over if it gets addressed at all. Mm-hmm. So we set out with our company. That's why I retired 5.5 years ago to start One Protection, is just to provide a tool for insurance and financial advisors to have a conversation with clients as an education to better understand what a out of work scenario would look like from a financial perspective. So that's why we built it.
And what is the feedback you've had from clients when they see the software, when they see visually on the screen? Are there more aha moments? Does it make more sense? What's sort of the feedback that you've received?
Yes, and yes, because we all there's an old saying, a picture speaks 1,000 words. Actually, the effectiveness of visuals over words or text is dramatically higher than even that. So we wanted to build a visual experience to help the clients understand and understand all the various parts of this discussion and decision making. And
Hmm.
so the feedback is, thank you. I finally understand what we're even talking about. That's what we get. So our clients are telling their advisors, okay, I now get it, because we just
Yeah.
didn't get it before because we didn't know what we're even talking about. So that's what the feedback that we've gotten from One Protection and why we built it the way that we did is just to help everybody understand their very specific situation in a way that their brains can get, we can understand it, which is visually rather than spreadsheets or numbers or words on a page.
Yeah. Because, I talk to clients all the time and everything is so hypothetical, and it's really hard to wrap your brain around what your human life value is. So maybe explain a little bit what that term means and how you explain it.
Sure. The human life value is the economic value, it's a present value of future earnings.
Okay.
And so if you think about anybody who's working, it's not what we're going to make this month, or it's not what we're going to make this year. It's how much money we're going to make over time. And that is the human life value. And so I always ask the question, what do we need to protect that? I call it the income asset. What do we need to protect it against? And the first thing, of course, is we have to protect it against a sickness or an injury, a disability that keeps you out for an extended period of time. But we also need to think about that income asset and that human life value. And what if it was a premature death? We're protecting the same asset. Again, this is a disability insurance conversation, but we're talking about the human life value, which needs to be protected. And that needs to be
Yeah.
protected against disability, which can sometimes lead to death. And sometimes people recover and other people stay permanently disabled. So we have to really think about, from a planning perspective, making sure that income asset is properly protected.
Yeah. And I think something um, that goes along with that is, a lot of our clients come to us and they're in their late 20s, early 30s, and they're just thinking they're getting their first job and they're thinking just day to day, month to month financially. And so I kind of think of it similar to a marathon. When you're doing marathon training, you just think on a day to day, here's what I need to do. I need to run 3 miles, and the next day, maybe four. And then you don't think about, I'm going to go out and run 26.2 miles. And I think the human life value and, what your software shows is the big picture, your big number. That's what you're worth, not on a monthly basis. I need $6,000 a month to pay my bills. Because if you're thinking about that, you just assume, oh, well, it's not that big of a deal. It's not that bad. My employer will take care of me, etc. So let's get into it. I'd like you to share
Okay.
your screen and
Okay.
maybe walk me through just a sample of what this looks like. And just note that some people are listening, so we want to also talk about visually what we're seeing. So
Sure
tell
thing.
me who this client is and what this does.
What I have here is I have a 35-year-old making $300,000. And if you ask a 35-year-old, do you expect your income to go up, down, or stay the same between now and the time you retire? Everybody's going to say it's going to go up. So I used a 4% growth factor here. And then we need to also figure in how long is it going to, how long are you going to work? When are you going to retire? Most people don't really have a set figure starting at age 35. They don't know exactly when they're going to try to retire, but let's just use normal retirement age, which is age 67.
Okay.
The human life value, for those who are able to see this, for a 35-year-old making 300,000 between now and the time to retire at age 67, that human life value is over almost $20 million. It's 19,862,000. And so that's the amount of money with a 4% growth that this client here is going to make. So the human life value is their number, which is on the screen here. And so when a client thinks about their situation, obviously everybody's numbers are a little different, ages are a little different, things like that. The point of this whole thing is that the income asset, the human life value, is a big number, and
Mm-hmm.
it needs to be cared for. That's what
And see
this.
what I find so interesting. So this 35-year-old's making 350,000 and aggregate throughout their career, assuming everything goes, 4% per year, their number is $20 million. If they were thinking about it on the terms of they went out and bought a $20 million house, what would be the first thing they would do? They would insure it for
Absolutely.
earthquake or hurricane or fire or damage, whatever that is. The bank wouldn't even loan them the mortgage unless it was insured. They were buying a business that was worth $20 million. The first thing you do is you insure it because everything relies on that. And so what I find so valuable about this is with the human life value of $20 million, that is far and above the most important and valuable asset. You better make sure that it's, well insured because every financial decision that you make, buying a house, paying for your kids' college, paying your bills, health insurance, whatever it is, all stems from that $20 million coming in between now and age 65,
It fun,
67.
it funds everything. And
Mhm.
so if everything's dependent on something, it's like we're in a house. If you're in your home, that's where you sleep. That's where your kids go. Everything needs to be is cared for. If that house burned down, we get a problem.
Mhm.
Same thing's true with the income. If that gets interrupted for an extended period of time due to a health event, we got a problem. And that's what this exercise is really all about.
Yeah.
Now, the second thing, Jim, you kind of it's really about the other assets. You brought up a home. One of the things I try to demonstrate, and we just use a client here who's got $1 million house. They've got a vacation condo. They've got a really nice car. These are all important assets. And everybody who's listening to this has assets that we insure, because we value them. Whereas the income asset has to be understood in context with the other assets we insure. Look at that income asset, that
Yeah.
$19.8 million versus the other assets. By far, it's the most valuable asset. So just to say it another way, the income asset is worth over $18 million more than all the other assets. This person here is insuring every day without thinking twice. This
Yeah.
is understand back to the human life value, how important it is to understand that our ability to get up in the morning and make money is our most valuable asset. And it's a big number that needs to be protected.
And what I find so amazing is people don't even think twice about insuring those things. People go out and buy an iPhone for $1,000 and get Apple Care for $250. So they're spending 25% of the cost of just replacing the phone, which a lot of people might even have enough in their savings to just replace it, but they don't think twice. They just buy the Apple Care. So they don't think about insuring their $20 million asset in the same way.
Which is exactly why we built the software. The way we did is to bring all these things into context to really understand the risk of the risk involved in this situation here is that when we're out for an extended period of time, the numbers are very large, which I'm going to try to demonstrate here in just a moment here, and that it's an asset unlike the motorcycle or the iPhone or the used car or the new car. We insure all those things because you know what? If I got in a car accident, I like to make sure my car is insured. Okay, my house burns down. I want to make sure it's properly insured. We do that for good reason because those are important assets. But we got to bring income into the same conversation because it is by far our most important asset.
Exactly. So what do you do for people or a lot of people say, that's nice, but I work for a big employer. I've got all of this handled. I just have it through my work. That
Right.
seems to be the biggest, that seems to be what a lot of people just assume, but maybe can you talk about how that comes into play?
Absolutely. The good disability insurance planning, income protection planning starts with understanding what we have in force today.
Mhm.
That's where it all begins. And so most people think that because they got short and long-term disability provided to them from work, that somehow or another it's going to be adequate amount. Well, it might be, but most of the time it's not. It's just misunderstood. So what we need to do is to understand it by doing this. Like, for example, this client here making $300,000 has a group long-term disability plan provided for them at work. It's 60% to $10,000 per month. So let's go ahead and flip this to a monthly amount. So 300,000 divided by 12 is $25,000 of gross income per month. Their group LTD is 60% to $10,000 per month. Okay. But here's the gross income problem. But nobody lives on 100% of their income. We got to pay tax on that.
Yeah.
So I just put in 25% behind the scenes. So this is about what our client here would be living on per month while working. And
So
this,
just for the people that can't see the screen, so if you're making $300,000, your gross is 25, but you're taking home, let's call it 18. Your
correct,
group provides 10,000 a month, but the employer's paying for it. So that ends up being around $7,200 a month. So
because
if
it's taxable, correct.
and typically in group, you have to be totally disabled, not partially disabled, not you can't work in your own occupation. You have to be typically, totally disabled, not working for
Yeah,
most group policies.
the
So the
definitions.
gap that you're showing, so you're taking home $18,000 a month net if everything's going well. Something bad happens, you become disabled or you can't work, 7,200 a month comes in. The gap, the difference between what you're used to taking home and what your group is providing is $10,800 per month. That's the vulnerable part.
That is the net income that's lost. I always ask people, hey, how much of your income do you need? You're working, you're making 300 grand. How much of that income do you need? And the answer is, well, all of it.
Mhm.
I mean, it's not like we're sitting around. Half of it's not necessary. It's we live within our means,
Well,
and
and I think what a lot of people also don't take into consideration. So maybe you live off, so this person's taking home 18, maybe they live off of 15, but chances are they're also saving 3,000 a month in their retirement account, their college accounts, those types of things. And if they become disabled, they're not only are they're not contributing to that and there's less coming into the household. So it almost it even more negatively impacts you. So it's not just what you're spending every month, you're losing the money you're saving for the future.
that's right. And there's three what I call three financial impacts when someone's too sick or hurt to work. One is the immediate income loss, which is what we're studying here. This is what we're going through right here. The second one, which you just touched on, Jamie, is no longer are you saving, you're actually draining assets. In this case here, if they're relying solely on the group long-term disability, you're hemorrhaging money at over almost $11,000 of net income per month. That money's got to come from somewhere. So you start to drain things right out of the gate. And then if you think long ball, what's the effect of that second area of planning? The draining part of it is your post-retirement income stream is dramatically affected because those
Mhm.
assets during your 30s and 40s that you're supposed to be accumulating are now being drained, which severely affects your ability to retire and have money down the road. So it's this cascading effect. When we don't protect that immediate income loss, it destroys financial plans for the short, medium, and long term. And that's what we need to prevent.
Yeah. And not to mention sometimes expenses go up if you become disabled. Your spouse or partner might need to take time off of work to take you to all your doctor's appointments. You might need to have other types of, medical equipment or out-of-pocket expenses that aren't covered by health insurance. So sometimes it's just the event itself can be very expensive.
And there's really two things that happen almost all the time to your point, Jamie, which is revenue tends to go down if you don't have your ducks in a row, it goes down very severely. And expenses do go up. For example, if you're an employer, they're subsidizing, you're paying a big chunk of your health insurance, and you're no longer employed there because you're totally disabled, you can go on COBRA, the continuation of health insurance benefits, but you got to pay for it.
Mhm.
And that expense right there, when I retired from principal, my health insurance, just for me and my daughter, went from 450 out of pocket, what I paid for per month to over 1,200. Just like
Yeah.
that. All I did is retire. So when someone's struggling with health, mine was voluntary to start a company. When someone's battling a health event and their expenses, uncovered medical expenses, the cost of health insurance, chasing the Cancer Treatment Center of America, these are all non-covered expenses that all tend to mount up. So when we demonstrate this is kind of best case scenario that you're losing
Mhm.
$10,800. And that means that you're draining money, You're not saving money. And oh, by the way, your expenses probably go up. And as you mentioned, what if your spouse has to cut back or quit their job to take care of you?
Mm-hmm.
That happens all the time. So
Yes.
revenue can go down, the household revenue can go down simultaneously. It's all these whammies, double, triple, quadruple whammies keep piling on at the worst point in someone's life.
Absolutely.
Okay.
We're talking with Michael Sir, co-founder of One Protection, about how visual tools are helping people finally understand income protection. When we come back, we'll dive into the biggest gaps consumers face and what the industry needs to do better. Stay with us. Welcome back, Michael.
Great. Thanks. Nice to see you again, Jamie.
Okay, so we know that there's a big problem here. You're used to taking home 18,000, your group's providing 7,200. There's a deficit on what you're used to taking home by 10,800. So walk us through the scenarios of how do you solve this problem?
It really starts with understanding the magnitude of the problem. We did that with the human life value, and we looked at the asset comparison. One thing we need to do is to look at scenarios that can be realistic. For example, I know people, I've been around for a while, I know people that have been too sick or hurt to work. So we've got to quantify risk.
Mm-hmm.
I always say the pain of the problem has to outweigh the pain of the solution. If we don't clearly understand what the problem is, no matter what we try to solve, it doesn't make any sense. It doesn't connect. So let's understand what the problem is. So we've got a 35-year-old who's works out, doesn't think anything bad's going to happen to them, and it probably won't. But if you think about people we know in our lives that might have been out for a period of time, for example, I've got many stories, but my dad had back problems about age 52, and he was out for 4 years.
Mm-hmm.
If that were to happen to this client, if that was his dad, that's the out of work window from age 52 to 55 with the group LTD plan is a $2 million loss.
Yeah.
Now we start to quantify, what if I had a cousin who had a stroke in her early 50s and she never worked again. She passed away in her 70s, but it was just this out of the blue stroke. What if that were to happen to this person here? With the group LTD, that's a $10 million loss. So now we're better understanding the quantification or the numbers behind what we need to replace, because this, again, starts with the human life value and the interruption of the human life value when someone's too sick or hurt to work. And so that's how we got to first frame it up. So the next thing to do is when we're working with Jamie, is for Jamie to go to a carrier. So maybe, Jamie, you can just tell us what you do when you've got a client that's got a pretty big problem like this. What do you do next?
So somebody comes to me and they tell me, okay, I understand that this is a risk. I want to take care of it. What do I do? So what we do is we first figure out how much are you eligible for. So the companies won't allow you to insure 100% of your income. So typically you can cover, and if you're paying for a policy individually, the benefits are tax free. So you can typically insure about 75 to 80% of your take home pay. So the first thing that we do is we figure out, okay, what's the income? In this case, is 350. They have a group policy that pays up to 10. Maybe we supplement with an $8,000 a month benefit, something like that. And then we determine, what are the more important factors that we want to make sure it covers them if they're a physician in their medical specialty or in their occupation. Do we want partial? What are the riders? What's the budget? And then we customize it to figure out what's the right solution for them. And then we shop around the different companies and see which one's going to be the most cost effective and the most suitable, if there's discounts, et cetera. But again, they come to us and we determine how much they're eligible for, how much they need to have, and we take it from there.
Okay. That's an amazing process. And I think that people need to understand that we're shifting risk.
Mm-hmm.
When you buy insurance, the art of insurance and the purpose of insurance, no matter if we're talking about homeowners insurance or car insurance, whatever, it's who's going to accept the risk. And when you buy disability insurance, we're simply shifting the risk. Look at this risk here. I mean, we're talking about millions and millions of dollars from personal assets to an insurance company.
Mm-hmm.
But a disability policy is going to take over in this event here at age 52 and is going to supplement that group long-term disability there and provide an adequate amount of money to come in. And as Jamie mentioned earlier, the goal of disability insurance isn't to over-insure someone, but the goal is to keep them to 80 to 90% of their take home or their net income. And what that does, that allows them to stay in their house and be able to preserve their lifestyle so the kids still can go to soccer practice and you can still have a good life, the life that you've been building, but not make you as good or better off, then there's no incentive to come back to work. We're still alive here. This isn't a premature death. So insurance companies are going to come up with a maximum amount that Jamie's going to find for you. And then what you need to do is to think about, is that the right amount for me? We got to figure out how much do you need coming in? Well, by the exercise that we've gone through, you kind of need as much as you can get because we don't know exactly how this would play out, if it plays out at all. And so then the second factor in there is how long does it make sense for this policy to pay? In this example here, I have a 52-year-old who's out, never recovers. Well, if you had a 5-year benefit period, what happens after 5 years? It stops. So it's better, and premium's always an issue. So you always got to, we always got to take budgets into account. But if you're going to buy a good disability policy, have it go to when you need it, which is to age 67, your normal retirement age. The next thing you need to think about is how soon do you need the money coming in? That's what we call elimination period, or the period of time you have to be disabled before benefits start to come in. And depending on how much money you have, you could do a 90-day elimination period or a 180-day elimination period. That's the period of time you have to be disabled before benefits start to accrue. And the longer you can wait, the less expensive it is. So these are the things that, Jamie, you work with people on, is to figure that out. And then you come up with the last piece is, what's the budget allow for? Finding the right dollar amount to provide the premium dollars in order to have an adequate or a quality disability plan. Because if we guess wrong there and we underinsure ourselves, it's like if your house burned down, you found out you only insured it for 40% of its value. Well, everybody would be completely appalled at the idea of that. Well, a lot of times we do that for our incomes, which is the biggest mistake of all. And so,
and I find what's interesting on this chart too. So you're showing somebody who's disabled at 52. Sometimes I have people come to me when they're 52 and we talk about that benefit period. Do we need to age 67 or 5 years? And again, sometimes it depends on, again, how much they've accumulated, how much debt that they've paid off, and the price. So sometimes when people are, 50, they just want to kind of get through the finish line, that maybe the house is paid off, the kids are in college, they just want to get, till age 60. And at that time, maybe they do have enough assets. So again, they might be able to just supplement the risk. Maybe they don't need to insure that amount, but they need to at least take into account what that potential loss. And some people just say, what, I'd rather, like you said, leverage the risk. I'd rather pay it in premiums. And if something happens, I don't want to tap into my $10 million portfolio. I'd rather have it paid out.
Well said, because again, even if you stopped after 5 years, so the 52-year-old gets to 57, great. The question then becomes, do I need the policy as in its current form? If you bought it to age 67 benefit, protecting it, by then they might say, I'm getting to the point where I could probably retire today. Well, maybe cut it back at that point. So, but until you're to that point, then we're gambling. We're taking a lot of risk on, because if the 52-year-old says, well, I only need for 5 more years. Well, what if that 5 years gets interrupted?
Yeah.
That's the problem, is that then the plan kind of breaks down because you needed 5 years of earned income. Well, then what? So it can break down quickly. So I always caution, say, it's better to have what you need now and adjust it and reduce it over time, rather than now I think everything's going to be okay. 5 years, I'll either be dead or I'll recover. Well, you don't know that. I mean, so there's a lot of assumptions that I think are just better when we might be the most conservative investors ever, but when we come to income protection, we become very, very risky because we're taking on too much risk. Why would we risk that $10 million that you've built and saved and everything for your post-retirement? Why would we risk that? And that's what you're.
So what do you say to people? They say, this is great. I know I need it, but it's really expensive. I'm on a tight budget. I can't afford this. What do you say to people that say, I understand, I've got a $20 million asset, I have some through work, I'm just trying to make ends meet, or I'm on a tight budget, this just seems way too expensive?
Well, then which one's more expensive, trying to find premium dollars or trying to absorb a loss like this? Premium dollars are several $100s per month. a loss like this is $10 million.
Hmm.
So it's cost benefit analysis. What do you get for shifting? What do you get for the premium dollars to shift the risk? And when people, that's where the risk, most people are risk averse. They don't want to just put everything in the highest, all their investments into the most risky categories. Most people don't do that. Why would we do that with the one asset we can least afford to lose, which is our income? Because if we guess wrong there, we lose everything.
Yeah.
Everything's gone. That house, that cap, the number one reason for bankruptcies and home foreclosures year over year are health events. That should help us understand the risk there is very real. Why not shift a little bit? Maybe it's 2% of your income. If that's the budget, shift 2% of your income into an insurance plan to protect the 98% versus not doing anything. You got 100% of your income, but if you guess wrong, you're going to lose short, medium, long-term savings and lose your home. Your whole financial plan starts to blow up.
Yeah, I mean, if you look at a $1 million home, probably costs $4,000 a year to insure. And those rates escalate every year. So it goes up and up and up. So that's 4% of the value. The amount to insure an income for men, it's again, let's say you're in your 30s when you're getting a policy with all the bells and whistles, costs between 1% and 3%, depending on the occupation, et cetera. And for women, it's about 2 to 4%. So it might actually be a lower proportion to protect an income than it is to protect a car or a house or the iPad, which you're paying 25%. Like if you look at it from those terms, it makes a lot of sense.
It does. I always say make the unknown known by using the familiar. We're familiar with insuring these other assets. And when you look at those value, remember the other assets. For example, here, we've got a home worth $1 million, vacation condo. If you roll those things into one number here, that's about $1.5 million. But that income asset is worth so much more. The question is, how much does it cost to insure these assets versus this asset? These assets would probably be $10,000 a year.
Yeah.
To insure this with a good individual disability is probably going to be $3,000 a year. So the point is that the premium dollars for disability insurance, it's by far the least expensive insurance, the insurance that you can buy when you're protecting other assets compared to your home or your cars or your iPhone or whatever it is. Yeah. Any of those other assets that we insure, disability insurance is by far the least expensive.
So when you're talking about, you work with a lot of financial advisors who use your software. Why do you think a lot of financial advisors are reluctant to recommend disability insurance or income protection?
Well, the harsh reality, just if you take a couple steps back, is that 95% of those who are licensed to sell life insurance and disability insurance and stuff like that sell very little to no disability insurance at all. And I think there's a lot of reasons for it. If I ask that same group of people, hey, do you think that income protection or disability insurance is an important part of a financial plan? All of them say, well, of course it is. The question is, why don't more advisors pursue it? I think it's a combination of things. One is they might be focused on other areas, maybe property and casualty, or maybe they're just managing assets or whatever. They could be focused on other areas. So they just don't either have the time or the capacity to talk about disability insurance for their clients. I think it's a bad idea. I don't think that you're serving the clients properly, but that might be the reason why. I think the bigger reason, though, is that the tools that are available aren't very effective until we build one protection. And if you can tell the story, the client looks, clients look at it and say, I don't really see a problem here. I'll be okay. My spouse works or whatever. All these natural, what I call optimism bias objections. Optimism bias is how our brains are naturally wired, that somehow or another, everything's going to be okay. The odds of something bad happening to me are far lower than everyone else around me. That's a mistaken belief that things are going to be just fine. It's a bad strategy because hope is not a strategy. You got to put some pieces together.
Yes.
The goal is to make sure that people understand that the optimism bias is in check, that bad things do happen to good people. People do live long to 100 years old. Other people die well in advance of that. Disabilities do, in fact, happen 3 at least 3 times more often than a premature death during the working years. These are realities that we've got to plan for. But most advisors, because they're not having success in it or they're just not comfortable with it, they just avoid the topic. I'll give you an example. I talked to a financial planner yesterday, been in the business for 30 years, and she's super sharp. We went through this and talked about it. And she said, wow, I would just go through a financial plan. When I'd hear that somebody's got, my client would say, no, I've got that through work, I'd check a box and just move on. I never thought about it before. So
Wow.
just advisors being ignorant on the realities of what their clients will face if someone's battling cancer or has had a stroke or has had an injury of some sort. And so I think it's a problem. And that's why I'm glad that you're such a passionate disability seller, Jamie, is that your clients are going to get good information. They're going to make a good decision here. And even if they decide to buy a 5-year benefit period, or they decide, you know what, I've got $10 million, I'm going to self-insure, at least they're making a decision based on the education and the knowledge of what's really going to be the risk that they're really going to be facing. And 95% of advisors don't do that at all.
Yeah. Well, I really appreciate you coming on here. I love your enthusiasm, your knowledge. I really think that what you're doing is great by educating a lot of these financial advisors and people to educate them, because I think there's a gap also in the education. I think that a lot of people, like you said, aren't even aware. They just assume, that their employers are going to take care of them. And I think it's really up to people in the industry to advocate on behalf of people who really, really need to protect their incomes. So thank you for coming on the show today. Really, really enjoyed our discussion.
You're welcome, Jamie. Thank you so much. Thank you for your passion. And I just encourage anybody, whether you're a client or someone, just really take this area of planning seriously, because if we guess wrong here, everything else kind of starts to collapse.
Yes. Thank you.